I'm excited to present today on a topic that I have a lot of passion about, and we'll just get right in. So I've been doing business valuations for over a decade and several hundred valuations of SBA for 7A purposes. So today's topic comes out of that knowledge that has been gleaned over the past decade with several hundred business valuations for SBA 7A. So without further ado, let's jump right in and take a look at some of these topics. So which standard of value? You may be surprised that the SBA SOP is silent on this topic, but the two standards of value that that are options, since the SOP does not allow for a liquidation scenario, would be fair market value and investment value. So I will tell you from experience and working with various lenders across the country, from California to New York to Florida and everywhere in between, that for the most part, lenders indicate that fair market value is what they're looking for. And then if you look in the SOP, even though you don't find under business valuation that there's no language that says, well, a business valuation has to be at fair market value. However, the term fair market value does show up 15 times in the SOP. So based upon that and the fact that the lenders that I've worked with have all indicated that they expect fair market value. So you may say, well, what's this got to do with the SBA 7A program? So this is speaking to the scenario where you have a synergistic buyer who, unlike the hypothetical buyer, which is a fair market value standard, the fair market value, you may recall, is the price in terms of money that an asset would exchange hands between a willing and able buyer and a willing and able seller, neither under any compulsion and both aware of the reasonable facts. That's the classic definition, fair market value. The investment level is the value of a business to a particular buyer. And so, as you all probably are aware, the investment value can be higher than fair market value. Often it is. And by definition, it should be, because the investment buyer is already typically in an industry or in the same business as the target. So let me give you an example. If you are, let's say you're I just sold a landscaping company a few months ago. After a few years of trying to find a buyer, we finally found one and closed. And the buyer was an investment level buyer. It was a private equity group that has a silo in the landscaping territory. And they were able to pay 6 times EBITDA. So the fair market value, though, of the landscaping business was probably closer to 4 times EBITDA, between 3 and 4 times EBITDA. And so the reason why the buyer we found could pay more is because they had synergies. They were going to be able to eliminate some staff that a fair market value buyer would not be able to eliminate. For instance, they already had a CFO, the buyer did. And so they were able to eliminate the accounting position at the target. And a hypothetical buyer would not be able to do that. A hypothetical buyer is someone who is coming in without those advantages that you have when you have synergies that you've developed because you are in a similar industry or the same industry. So again, the fair market value is the hypothetical buyer, not the known buyer who has certain synergies. So I would just leave this. I'll leave this screen with the SOP is silent. There are probably some lenders. I'm not going to say every lender is going to stick to fair market value, but from what we've seen, fair market value is the by far the majority. And I'm looking for an SBA directive on this. I haven't received it yet, but I anticipate that at some point the SBA is going to have to really come out with some kind of letter ruling. So I see we have a question. I'm going to leave that. We are going to take questions at the end, so I'm going to leave that for later. But we appreciate all questions. So just be patient, and we will get to those. I'm going to move on now and switch gears to the documentation of add backs. So as you all can imagine, add backs like depreciation, amortization, above market wages to the owner, let's say wages paid to an owner's spouse when the spouse doesn't participate. Those obvious add backs, no additional data is necessary for a lender, for verification of that. Business tax returns, W-2s are enough to substantiate that. However, not so obvious add backs like expenditures for personal items. I recently worked on a valuation for an SBA lender, and it's in pre-lending stage, and the SBA lender asked if we would get involved and do a kind of a forensic analysis to determine the legitimacy of some add backs. And some of the add backs included, and you all probably heard this one before, but the buyer or the seller had ran some expenditures for a cabin in the mountains through their business. And so they had ran it through cost of goods sold. And so there was some, they wanted an add back for that. There were other add backs for, obviously, we've all heard, travel and entertainment, those kinds of things. But really focusing back on the cabin, the cabin built, that has nothing to do with the business, obviously. Those kinds of add backs need to be substantiated with additional documentation. So in my experience, if you do have add backs, if your seller has add backs like that, the banks are open to that if they can be substantiated, and they need to be substantiated through the general ledger. Through a quality of earnings is probably the best way to substantiate that. And I know some of the smaller deals may not warrant a quality of earnings, but if you can get the general ledger detail from the seller and maybe work with their CPA firm, you can go. It goes a long way with lenders and certainly with business valuators if you have that documentation. The one caveat I would say is just be certain that the add back, the quote add back, hasn't already been reclassified to some other account like distributions. I'm not going to go into distributions, but distributions like on an S corp are not. They don't hit the P&L. They don't hit the income statement. So it's not an add back. A distribution is actually a reduction in equity. The journal entry is a credit to cash and a debit to distributions. And so some of the items that were being requested in this scenario I got involved in recently were already reclassified to distributions. And so there was significant amount of the add backs, the quote add backs, that had already been they were already put in distributions or reclassified to distributions, and rightly so, because some of them weren't add backs. They were actually not add backs. They were necessary. Some of them were add backs, but because they had already been classified to distributions, as I was mentioning earlier, those add backs weren't hitting the P&L, so there was no expense. For example, in this recent scenario, they had this particular target had been paying commissions to a company that those commission arrangements would no longer take place in the future. They had ran the course of the agreement. I think it was a 3-year agreement to pay commissions on certain sales that they were making. So that add back was legitimate, and we substantiated that. And the commissions were substantial. But those commissions weren't going to continue in the future. And so that was an adjustment that wasn't in the obvious add backs, but it was definitely something that we could corroborate and substantiate. So let's move on now to the next slide. We're going to talk about if the business valuation is lower than the purchase price. So this is something that you may experience in your practice from time to time when you're trying to help a seller, and you find out after all that's been said and done, all the blood, sweat, and tears that you put into the deal, and the seller is put into the deal, and the buyer, and you find out that the business valuation came in lower than the agreed upon price. And I will tell you this, that deal can move forward. It just can't move forward with a lender via the 7A product, the SBA 7A. It can't move forward with the addition, can't move forward with that product. So, for instance, if it's been agreed that a business is worth $2 million, but the valuation comes in at $1.5 million, the lender can loan up to the $1.5 million. The $500,000 above the fair market value would have to be either an additional equity injection by the buyer, or it could be a seller note by the seller, or I believe a combination would work. So don't give up hope. Hope is not lost if a valuation comes in below the deal terms. And I'll encourage you with this, as a business broker and as a valuator who does 7A valuations, I would just encourage you to be involved with the valuation process, and reach out to the business valuator during the process. And if you know something that you think is going to be helpful, go ahead and mention it. And also, you could ask them, or you could share with them that, hey, if you come up short, please let me know. If this valuation looks like it's going to come up below the agreed upon price, and that way you might stave off this whole scenario, especially if you have some information that could be corroborated, but the valuation firm just they're not aware of it, and the bank isn't aware of it either. So I would just encourage you to, again, to be involved in that process, and to help make sure that the valuation firm has everything they need to ensure that the valuation is as accurate as possible, and credible and independent. And I think that'll go a long ways for you. So let's move on one more slide here in a minute. So partial changes of ownership. So this is that new provision that was added into SBA, the SOP 5010.7.1, which is the current SOP that governs all the lenders. And so the loan proceeds now, but prior it used to have to buy out everybody. It used to have to be a 100% change in ownership, or basically the owners that were selling had to leave, basically. So previously, if someone wanted to buy out, say, a 25% owner, and they owned 50% and someone else owned 25%, let's say that out of the 25%, one of the 25% owners wanted to sell 20% of their ownership. But previously they couldn't do that using this, the 7A product couldn't be used to finance that 20% buyout. Now, out of my example, the 50% and the other 25% owner could buy out the 20%, 25% owner, they could buy 20% of their shares and allow them to maintain a 5% interest, and they could continue to work there. You recall previously under the prior SOPs until this latest one that the seller could not be involved with the business for more than 1 year after the transaction date. And they could not be a W-2 employee. They had to be a 1099 independent contractor. Well, now the SBA has taken a position where you can stay on. That person in my example that sold 20% of their 25% interest could stay on as an employee and continue to work and help that business thrive, which is often helpful for the folks who are buying out the person who's selling, because that person may have some relationships and do some duties that would be difficult to fill in a short period of time. But given enough time, the transition would likely go smoother in a lot of instances. So we've got up to 2 questions now, so that's good. Any questions, just feel free to put them out there in the chat, and we are going to get to those, or raise your hand through the Q&A. The valuation of a partial interest will typically be a pro rata share of the value of the whole business. So in this next example, let's suppose that a business is valued at $1 million, the whole 100% interest. If someone's going to buy 20%, then 20% of that 100% interest is going to be $200,000 of the million. And the reason why I bring this up is because there may be some confusion. I had one all-star banker mention this to me, that some folks are, they're confused and they believe that, okay, we'll only sell 80% for $1 million. In this example, let's say the valuation and the cash flows only really substantiate or sustain a $800,000 value, fair market value. So you can't say, well, we're going to sell 80% for 800,000, and that's the way we're going to make up for the difference. So you can't. This particular provision, I think you just need to understand that valuation is it's not going to change if someone's buying out a partial interest. In other words, if it's a $1 million business, it's a $1 million business, and then if you only sell 20%, 80% is only worth 800,000. It's not worth $1 million. So I think that's pretty intuitive, but again, I had a banker recently mention that at a business broker conference that I was at with a lender. This particular lender mentioned it. So I wanted to bring it up here just for your edification. Discounts for control or marketability. For those of you who are familiar with valuing a partial interest of especially less than 50%, then there are valuators we take into account whether there's a discount for control and or marketability. Well, marketability can also be called liquidity, because it's much more difficult to sell 49% interest in a business than a 51% interest in a business. And so you have issues with control because the 51% owner has control, but a 49% owner has no control or very little control. And so what we find is that a 49% interest, if it's $1 million valuation, a 49% interest doesn't necessarily mean it's going to sell for $490,000. but we do not really take into account these discounts for control or marketability when we're looking at these SBA partial buyouts. At this point, those discounts for control or marketability are not really looked at. They're not examined, and we're just doing a pro rata share of the whole. And I think that maybe this is the case because typically you're going to end up with a 100% ownership interest. What you're going to end up with a 100% ownership interest, and there are reasons within the SBA program that makes these concepts kind of a moot point, I believe. A couple of them being the fact that they're going to take liens on anybody they can. The lender's going to have to do that. So it's not exactly the same as being out in the marketplace and you're buying, say, a partial interest of less than 50%, and you don't have a bank involved and you don't have the SBA involved. So we're up to 5 questions. So very good. I can't wait to get to those 6 now. So we'll just go right into the bonus items, and then we'll get to the question, because that's really where I think we can all enjoy good dialogue. So other pertinent items: ensure interim P&Ls and balance sheets are on the same basis of accounting as prior year infos. All the info should be the same. This doesn't pertain to business tax returns versus financials, because sometimes a business is on the cash basis for, say, tax returns, but they're on the accrual basis for financial statements. That's perfectly fine. But if you're submitting financial statements to the lender and you want to make sure they're all on the same basis of accounting. If you've got 2020 through 2024 interims, you're going to want to make sure that they'll say you're submitting accrual, that every income statement and every balance sheet is on the accrual basis. And the business tax returns this doesn't pertain to, because they are what they are. If they're on the cash basis, that's what you submit. If they're on the accrual, that's what you submit. Again, another topic that is a hot button with bankers is working capital. I have been apprised that working capital is the leading reason for stressed assets. And when I was doing some research for this presentation, I was reminded that working capital is something that is in the SOP, that the lenders are, required to ensure that the borrower has working capital coming in, or they're going to have to borrow the working capital, or the seller is going to have to provide the working capital. So somebody's got to provide the working capital. It's either going to be, either the seller is going to, which doesn't happen often in the Main Street area, and even some of the mid street, I would say, happens more often with deals that are bigger, where some of the working capital is included in the deal. And what I mean by working capital is mainly cash and receivables. Inventory is included, as we all know, typically in a deal. So then, again, working capital, your buyer's going to have to come in, the seller's going to have to provide it, or the bank's going to have to loan on it. And the banks don't mind loaning on it. But just remember that this is a big stressor for a lot of people. They don't plan very well, and then they get behind the wheel of the business, and they don't get too far down the road sometimes, and they realize they don't have enough cash to continue the business before the cash flow cycle starts producing enough cash to pay all the bills.